Welcome to the deep dive. Today, we're getting into something that feels really immediate right now, making sense of all this uncertainty, in the global economy and technology. We're looking at insights from Timur Turlov, founder of Freedom Finance.
That's right. We've sort of synthesized an analysis of his discussions, looking at key themes like the incredible pace of change, AI's huge impact, strategies for growth when everything feels unstable, how investing might need to change, and this really central idea of trust.
Yeah, and our mission here is really to cut through all that complexity. We want to pull out the most important nuggets from this analysis, just to give you a clearer sense of these shifts and, well, what they might mean for you.
Exactly. Think of us as guides, maybe. We'll unpack the core ideas, try to highlight the surprising bits, the practical things that might help you navigate what feels like a pretty dynamic world.
So let's just dive in. I mean, it feels obvious, but the ground is shifting constantly, isn't it? Uncertainty everywhere, economic, tech, political.
Oh, definitely. And Turlov hits that right away. He talks about this unprecedented pace of change, market disruptions. He puts it quite starkly, actually. He says, the world and markets, they can change cardinally. Nothing we are used to will remain.
Wow, nothing we are used to will remain. That's quite a statement. And he sees digitalization as a big driver of this.
A huge driver.
Yeah.
He argues it's amplified things so much that a company, hypothetically, can lose all its clients in 1 week, which he points out before all this digital stuff was purely technically impossible. It's not just faster evolution, it's like warp speed disruption.
Okay, so those traditional defenses, those big moats, like, I don't know, physical buildings or long-standing relationships, they just don't cut it anymore.
They're dissolving, yeah. He argues they're becoming much less effective. And this forces a really fundamental change in how businesses need to think. Innovation, flexibility, they can't be like special projects. They have to be baked in, continuous, core functions.
And that implies different structures, too.
Yeah, flatter structures, faster iteration cycles. You just can't wait months for decisions anymore.
It sounds, honestly, a bit relentless. And this is all happening against a backdrop of, geopolitical instability, economic wobbles. Is that just the new normal?
Turlov seems to think so. He says, in our game of uncertain data, there is more and more every day. And it's not just in one area, right? It's economics, politics, technology, it's all interconnected. He links this new technological revolution directly with big political uncertainty, conflict, tension, populism.
But he has this interesting, maybe counterintuitive take on crisis itself. He sees it almost as an opportunity.
He does. He has this memorable line. Nothing helped us as much as the worst crises that happened. It's not just being optimistic. His point is that crisis acts as this powerful force for redistribution. It shakes everything up.
And favors the adaptable.
Exactly. It strongly favors those who can pivot quickly. Which means, competitive advantage isn't just about being the biggest or strongest in absolute terms anymore.
It's about being more flexible relative to everyone else who struggle.
Precisely. The nimble players can actually use the chaos to get ahead. And this also means those old risk models, the ones that look at risks in neat little boxes, they're probably not sufficient.
You need a more systemic view.
Yeah, a holistic view, because these global risks are all tangled together now.
Okay, so in this fast, messy world, what does Turlov see as the main engine driving the change right now?
Well, for him, it's clearly artificial intelligence, AI. He sees it as the primary driver of this technological revolution, and crucially, as this vast, mostly untapped opportunity. He calls it a huge blue ocean.
A huge blue ocean.
Yeah, and here's the kicker. He admits that right now, no one knows how to use it fully effectively. Not really.
So it's this massive potential, but we're all still figuring it out.
Pretty much. Which creates this enormous competitive gap. He stresses those who catch this wave and use these opportunities, they get gigantic advantages over those who don't. He even mentions a kind of winner-takes-all dynamic like Google with search. It's not just another tool, it's a fundamental capability shift.
Mm-hmm. So for people listening, maybe not in a tech role, does this mean things like AI literacy or prompt engineering suddenly become really important for everyone?
He's emphatic about that, yes. He sees these as becoming core business skills for everyone. He actually advises investing your time and energy learning to use AI models, learning to write good prompts. He calls it a fundamental meta skill.
Okay, let's make it practical. How does Freedom Finance actually use AI? Can you give some examples?
Sure. Well, Turlov uses it himself, personally. He talks about using ChatGPT almost like a second opinion for management stuff,
Yeah.
checking his own answers, getting quick takes on legal questions, even querying databases without needing to be a SQL expert. He finds it sharpens his critical thinking.
That's interesting using it to challenge yourself. What about bigger operational things?
Oh, yeah. On a larger scale, they've automated a huge chunk of their compliance work. They trained AI models specifically for that. And it let them significantly reduce the number of compliance officers needed.
How many are we talking?
He mentioned going from around 130 officers down significantly. And it also massively sped up processing documents, payments, that sort of thing.
That's a concrete impact. Any other big examples?
Yeah, in Kazakhstan, they fully automated their mortgage application process.
Yeah.
Completely.
Mm.
It apparently went from taking weeks down to just 2 hours.
2 hours for a mortgage.
2 hours. 0 human steps in the middle. Which is, not just faster, but a massive cost saving and a total rethink of how it's done.
Wow. And they use machine learning for risk too.
Yes, and this is where it gets into what he calls hyper-personalization. For credit risk, insurance risk. They use machine learning that looks at tons of data, not just the usual financial stuff, but like behavioral patterns, driving style data, weather, even court decisions on accidents.
It's incredibly detailed.
Exactly. And the goal is fair pricing. Instead of just pooling everyone together where good risks subsidize bad ones, they try to price the risk very precisely for each individual. It's AI really disrupting how risk is assessed.
Given how powerful this is, what's the advice for bigger organizations or even governments thinking about AI?
2 big things Turlov highlights are customization and data security. He points out why, say, a country like Kazakhstan invests in its own AI solutions. It's not about beating Google at general AI. It's about deep customization, maybe for the Kazakh language, and critically managing security issues around sensitive, confidential data.
Right, so this idea of data and AI sovereignty becomes a big deal for nations and companies.
Absolutely. Controlling your own AI tools and the data they run on is becoming strategically vital. Just relying on generic third-party models can create big risks.
But you can still get an edge without building the world's biggest AI.
Definitely. That's the concept of niche AI dominance. You might use a big general model as a base, but you tune it or train your own smaller model on your unique proprietary data, like a bank's specific compliance history or a retailer's customer interaction data. That gives you a huge advantage in that specific area that a general AI just can't match easily.
This all just screams adapt or fall behind, doesn't it? And Turlov has a strong view on the best strategy here. It's not about defense.
Not at all. He's very blunt about it. He thinks defending your current position is a very bad strategy. He says, attacking is always better. Always better to try to expand something than to protect something. He even references that old American banking saying, acquire or be acquired.
So in this kind of volatile world, doing nothing, just trying to hold on, that's actually the biggest risk.
That's exactly his reframing. If defending doesn't really work, then standing still means you're likely falling behind. The risk of just stagnating outweighs the risks you take by trying to grow or expand aggressively. Proactive strategies aren't just nice-to-haves, they're almost necessary for survival.
And M&A, mergers and acquisitions, it's not just about buying market share anymore.
Not primarily, no. For companies like Freedom Finance, when they acquire startups, it's often as much about getting the team, the talent, the technology, that ability to innovate quickly as it is about the customer base. M&A becomes a way to basically fast-track development and bring in needed skills.
This ties into the idea of building ecosystems, which seems really central to their whole approach.
It really is. Transforming from just a brokerage into a wider banking group, for instance, was partly inspired by seeing how others, like Tinkoff, used an existing customer base to efficiently move into related areas. Digital banks show this perfectly, serving millions with hardly any physical branches.
And data is the fuel for this ecosystem strategy.
Totally. You use the data from customer transactions to understand what they need and then offer personalized services within that ecosystem. Maybe investments, maybe loans, maybe insurance, maybe eventually other things like travel or shopping if it fits the data. It's about serving more of their needs.
The example of their referral program really drove this home, didn't it?
It was pretty amazing. They used small incentives, like up to $5, plus some cashback offers. Not huge amounts, but it led to, 73,000 new signups in a single day.
73,000?
Yeah. And the cost per customer was apparently only around $3, which is tiny compared to the industry norm of, $40 to maybe $270 or more. It just shows the incredible power of network effects, the social effect, as he calls it.
So the ecosystem itself becomes this really strong, data-powered competitive advantage, a moat.
Precisely. It feeds itself. More services used means more data, which means better, more relevant offers, which builds loyalty, which leads to more data. The data becomes this dynamic protective shield.
And that viral growth, the shared value thing,
Yeah.
it's more than just the cash incentive.
Oh, yeah, definitely. The $3 helped, sure. But the success relies on having a product or service that people actually like and find valuable. Maybe it's the app design, the service quality, the cashback, the feeling of trust. When people genuinely want to share it because they think it's good, they become your best marketers. They're advocates, almost co-owners, promoting the ecosystem.
Okay, let's switch focus a bit to personal finance, to investing in this kind of environment. High inflation, lots of volatility. Does the old investment advice still work?
According to Turlov, not really. He's pretty direct. There will be no peace anywhere. And his key point is, if you try to find maximum safety, maximum calm in your investments,
Yeah.
that actually makes you the most vulnerable.
And he's particularly critical of just keeping money in, say, low-yield bank accounts or government
He
bonds.
calls it a very bad strategy, flat out. He believes it's guaranteed will lead to the loss of this money over time, simply because of inflation eating away at its value.
Right, the inflationary erosion of savings.
Exactly. Those supposedly safe options are, in his view, a guaranteed way to lose purchasing power.
Okay, so if the traditional safe havens aren't actually safe in real terms, what are the rational choices?
He boils it down to two more or less rational ways to invest your money: shares, stocks, and debt, bonds.
But specifically corporate debt, not just any bonds.
Yes, he emphasizes corporate debt bonds issued by profitable, large, well-run, audited companies. He makes an interesting point that, especially in some developing markets, corporate bonds were historically often better bets than stocks because the yields were good, and the owners were usually very careful about paying back debt, even if they weren't always keen on sharing profits with shareholders.
And for people with a decent amount of capital, maybe $50K to $300, what's the advice there?
His advice is put more than half of it into shares, into stocks of companies that are, in his words, doing something beautiful.
Doing something beautiful.
Yeah, by which he means companies that are actually growing, creating value, innovating, gaining market share. Those are the companies he thinks are most resilient, the ones that can adapt whether you have inflation or deflation. It comes back to this idea of a premium for productivity. Investing in businesses that create real value offers a kind of natural hedge against inflation because they can potentially adjust prices, improve efficiency, and keep growing their actual output. The focus has to shift from just looking at the nominal return to thinking about the real inflation-adjusted return. He does question government debt's productivity a bit. States borrow cheaply, and, well, their incentives to repay aren't always aligned like a private company's. Okay, let's wade into crypto. Turlov's view here is, well, it's not exactly enthusiastic. Enthusiastic is definitely not the word. He says pretty clearly he still doesn't really like the idea of crypto. He's particularly dismissive of things like meme coins, calling them an outright mockery of common sense, a completely empty shell with nothing but a name. He contrasts them sharply with traditional assets that have, centuries of trust and tangible backing behind them.
So his main issue with most crypto is the lack of real utility. They don't do anything.
That seems to be the core of it. He argues most of them don't have a real market they serve. They're not really being used widely for payments or as collateral for real business or for traditional investment functions.
He does seem to acknowledge something powerful is keeping them going.
Yes, and this is the fascinating part. He points to faith. He observes that people are quite religious and says the main back of the crypto story is real faith on which everything rests. And he concedes this collective faith is a big force. He even compares the communities around crypto to religious movements. Yeah. And because of that deep belief, even though he's skeptical, he concludes that crypto most likely will remain in the long run. The faith is too strong.
So they're almost like a new asset class, faith-based assets.
You could definitely see them that way. A very high-risk class where value, for many coins, isn't tied to traditional economics, but to collective belief and sentiment, which of course makes them incredibly volatile.
What about stable coins, though? Things like Tether, USDT. Does he see those differently?
He does, yes. He calls USDT a classic security. Basically, an IOU from the issuer promising to pay US dollars, like a banknote or a corporate bond in principle. He says the risks are just absolutely ordinary credit risks of the same kind any bank faces.
Like what? Like liquidity risk, not having enough cash if everyone wants their dollars back at once, asset devaluation risk if the assets backing the stablecoin lose value. And of course, asset theft, risk getting hacked. And he notes that the historical lack of tight regulation and independent audits just made these risks much bigger. It's a bit like shadow banking, doing bank-like things, but outside the main regulatory umbrella.
And he draws a line between Bitcoin and gold, too.
He does. He puts them in a similar category. He argues that gold, like Bitcoin in his view, doesn't really have much actual use beyond specific industries or jewelry. Its value is very unclear and largely based on faith, especially since we left the gold standard.
Interesting.
And while he admits Bitcoin could theoretically be worth anything if everyone adopted it, he finds that knowledge practically useless for making investment decisions now.
So both are maybe narrative assets. Their value comes from the story, the belief in scarcity. That's a really good way to put it. Less about what they do, more about the collective belief, the narrative around them, especially the scarcity story. There seems to be this ongoing human desire for assets that aren't controlled by governments, particularly when inflation is a concern.
And how does Turlov contrast this focus on narrative assets with his own approach?
It's fundamentally different. His energy, his focus, is on creating things, useful products, services that solve problems, make things faster, cheaper, better. He sees a huge alternative cost of speculation. Every hour or dollar spent trying to guess the next move of a meme coin is an hour or dollar not spent building something real and productive. For him, genuine, lasting wealth comes from creating value, not from playing zero-sum financial games.
Which brings us nicely to what seems like the absolute cornerstone for Turlov in this whole picture: trust.
Yes, he elevates trust, saying it's basically the highest form of currency in this new economy, especially vital for those ecosystems we were talking about.
He calls it the king on the chessboard.
That's his analogy, yeah. Trust is the king, and everything else, the products, the tech, the marketing, they're all pieces working to increase the amount of trust. And he says trust comes from successful joint activity and, crucially, matching expectations with reality. Basically, do what you promise, deliver consistently.
And ecosystems are good at building this because they have lots of interactions with the customer, the multiple touches.
Exactly. If you first help someone buy a plane ticket successfully, then maybe insurance, then concert tickets, each positive experience builds trust. So when you eventually offer something more complex, like mortgage, that trust is already there. It's a cumulative dividend of trust. And what this trust does is act as a huge friction reduction factor. Selling that complex insurance product is way easier if the customer already trusts your brand from simpler interactions. It lowers acquisition costs, makes people more willing to try new things within your ecosystem.
And building this kind of deep trust needs a human touch, right?
Yeah.
Especially from leaders.
He's very strong on this. Brands are always easiest associated with people. He really hammers home that trust is built on integrity and relationships within the team, with clients, plus clarity and transparency.
Didn't he have a specific comment about leaders and their social media?
Oh yeah, he said, having your press office run your personal social media is not cool. He believes in authentic, direct communication. It suggests there's a real premium for authenticity now. People can often tell when communication is just slick PR. Leaders who are transparent, consistent, genuinely engaged, they build much stronger connections. Their personal brand, if it's built on real integrity, becomes a massive asset for the company. And this implies companies need a culture of maybe radical transparency and real responsiveness. He mentioned the U.S. check system as an example of how trust can allow slow innovation. But in today's world, you need that immediate, genuine response, especially when things go wrong.
Like that technical glitch example he gave, that really illustrated the point.
He really did. They had some error that sent out like over 100 push notifications to clients, the kind of thing that could make people furious, right?
Absolutely. But they managed to turn it around.
Completely. They communicated clearly, apologized quickly, and then did something tangible. They gave out fractional shares as compensation, an airdrop. And instead of just calming people down, it apparently activated the base. It sparked this big positive reaction, a flash mob of engagement.
And he insisted that wasn't some clever PR stunt.
No, he was clear. Definitely not done on purpose. He said that kind of positive outcome happens absolutely naturally if that authentic responsiveness is already part of the company's culture. It really shows how a crisis can become an opportunity to build even more trust. If you handle it with genuine accountability and make amends, you can turn frustrated customers into advocates. But it underlines that you can't fake this stuff. It's a reflection of culture. Real brand strength comes from the inside. The values, the culture, how people behave authentically, not just from marketing slogans. It takes real work on the internal culture.
Okay, wow. That's a lot to process. Let's try to pull it together. Based on Turlov's perspective, what are the absolute must-dos, the strategic imperatives for businesses right now?
Okay, key takeaways for businesses. One, embrace AI as a core competency. It's that blue ocean. It's the edge. Two, prioritize adaptability and offensive growth. Playing defense doesn't work. You need to be proactive, use M&A strategically for talent and tech. Three, build data-driven ecosystems. That's your moat, your engine for viral growth and loyalty.
Hmm.
Four, cultivate authentic trust and brand integrity. Trust is the king, built on delivering and being transparent. And five, invest heavily in human capital, your team's ability to learn, adapt, be curious. That's your ultimate resource.
Right. And flipping that, for individuals listening, for you, how do we apply this? How do we adapt ourselves, our careers, our investment?
It really is a shift from the old playbook, isn't it? The old way was maybe gradual change, defending your position, a straight line career, putting money in safe assets,
Hmm?
valuing tangible things. The new paradigm Turlov is describing, it's hyperspeed disruption, it demands offense, expects dynamic careers with multiple stages, values productive assets over passive ones, and sees trust, data, and adaptability as the real keys to value.
So, concrete recommendations for listeners trying to navigate this.
Okay, first, commit to lifelong learning. Seriously. Static jobs are fading. You have to keep learning new skills, especially digital and AI-related ones. Expect to retrain, maybe even switch fields. Investing in yourself, learning things like prompt engineering, that's probably the best investment you can make. Second, actively cultivate adaptability and curiosity. Work on those meta skills. Get comfortable being uncomfortable. Try new things. Dig into areas you don't understand. Third, rethink safe investments. Focus on productive assets. Like Turlov says, low-yield stuff is almost guaranteed to lose real value. Look towards stocks or corporate bonds of well-run companies that are actually creating value and can potentially beat inflation. Fourth, balance personal comfort and productivity. Yeah, invest in your environment. Tools that make you effective, good workspace, tech. But don't just accumulate stuff or passive assets at the expense of actively developing your skills or business. Use resources to boost well-being and output. And finally, focus on value creation, not just speculation. It might be tempting to chase quick gains in speculative markets, but Turlow's point is strong. Building useful things, solving real problems, that's a much more reliable path to long-term security and, frankly, probably more fulfilling too.
It definitely feels like a major shift, moving from a world of maybe predictable steps and passive safety to one that demands constant adaptation, active investment in things that produce value and real engagement.
Absolutely. And the core message seems clear.
I mean,
Adapting, learning continuously, building trust, and focusing on creating real value.
yeah.
These aren't just nice ideas anymore. They're basically your essential navigation tools for this uncertain, but also potentially very rewarding landscape.
So let's leave you with this thought. If just having money parked somewhere safe means it's actually losing value day by day due to inflation, how does shifting your focus from simply possessing wealth to actively making your resources work through learning, through investing in productive ventures, how does that fundamentally change your personal strategy for the future? Thank you for joining us for this deep dive.